If my history is correct, our tax code was first drafted on scrolls with quill and ink. Today we're unraveling some of these scrolls to try and make sense of the infamous sections 1231, 1245, and 1250. It's a character study. Our business is the castle. What does the castle sell? Who knows? I just like castles. The castle sold 8 assets from its balance sheet. As you can see, we have cash, AR, inventory, the forge, the royal throne, the dining table, the castle itself, and land. We have the fair market values and tax bases for each. Gain is an easy calculation. Too easy for all you CPAs and future CPAs. You just take the tax basis from the realized amount or fair market value. But remember, this is a study in a gain's character, not its quantity. So with character in mind, let's dive into section 1231. The main thing to take away with this section is that it's friendly to the taxpayer, an affable character. As we unravel the 1231 scroll, keep in mind we won't be able to cover all corners of these sections today, but we'll stick to the core concepts. For 1231 property, we're talking about depreciable and or real property. This is property that's been held for more than 1 year. It's property used in the trade or business, and this cannot be inventory. It cannot be held for sale by the business. But again, the most important takeaway and why 1231 is taxpayer friendly is that 1231 gains are capital gains and losses are ordinary losses. This is best case scenario for a taxpayer with the lower gain rate or the deduction against the higher ordinary rate. So using that 1231 criteria, let's go back to our balance sheet to identify the 1231 property. Even I can do this, so I know y'all got this. And for the sake of the exercise, we're assuming all assets are held for more than 1 year. Cash and accounts receivable, we know we can't depreciate those, not 1231. Inventory, and we know it can't be inventory. Forge, the forge. That's gotta be depreciable machinery used in the trade or business. That's 1231. The royal throne and dining table, that's furniture, also used in the business of the castle. And the castle, which is the building, and land are depreciable or real property. So we have 5 examples of 1231 property. So with the first step of identifying 1231 property, step 2 is putting those assets into either the 1245 bucket, which is personal property, or the 1250 bucket, real property. No asset can be both 1245 and 1250. Back to our balance sheet. Which of our 1231 assets fall in the 1245 bucket and which 1250? The forge, the royal throne, and the dining table. That's machinery and furniture, personal property. Section 1245. The castle and land, real property. Section 1250. Let's go back to our why, and that's studying the character. Sections 1245 and 1250 represent possible recharacterization for gains in the sale of our 1231 property. Some context as to why we recapture gain. Well, if taxpayers have already benefited from deducting ordinary depreciation loss from these assets in the past, the IRS doesn't think it's fair to allow that in conjunction with the benefit of the favorable capital gains rate. So, Section 1245 and Section 1250 concern recapturing a portion of 1231 gain as ordinary income. So beginning with our personal property in Section 1245, we are only concerned with recapturing gain. All 1231 losses will eventually be netted against 1231 gains later on. Again, we are recapturing depreciation we've already taken as ordinary income. To do this, we have to consider each asset individually. So let's do just that. That brings us to our first asset to dive into, the forge. We already know the fair market value to be $120,000 and the tax basis $90,000. But now we need to consider the original cost basis so we can determine what depreciation has already been taken. So with an original cost basis of $100,000, we can calculate that we've already deducted $10,000 of depreciation expense. So of the $30,000 of total gain, $10,000 is going to be recaptured as ordinary gain under Section 1245. And the remaining $20,000 will remain 1231 gain to be carried forward in our eventual 1231 netting calculation. So $10,000 ordinary gain, $20,000 1231 gain. Our next asset in the 1245 bucket is the royal throne. It is shiny. With a fair market value of $20,000 and tax basis of $22,000, guess what? We don't even need to worry about depreciation recapture because we have a $2,000 loss. So that was easy. We'll bring $2,000 with us into our later 1231 netting calculation. Our third and final asset in the 1245 property bucket, the dining table. With a fair market value of $5,000 and tax basis of $4,000, we have just $1,000 of potential gain recapture. So with an original cost basis of $8,000, we learn we've already taken $4,000 of depreciation expense. But we can only recapture up to the level of gain we have. So we will recapture the full $1,000 gain as ordinary income under Section 1245. And thus, there is zero remaining 1231 gain. In shifting to real property, let's roll up our sleeves as we roll up the scrolls to understand Section 1250. Section 1250 recapture is a little different, as it is concerned with recapturing only the depreciation taken in excess of straight-line depreciation. This doesn't apply to any assets placed in service after 1986, but for assets placed in service in 1986 or earlier, any depreciation taken in excess of straight-line depreciation is subject to recapture. This is uncommon and just growing increasingly more rare as we move further and further from 1986. But what is much more relevant for Section 1250 is what's called unrecaptured gain. All the depreciation that's been previously taken could potentially fall in this bucket, which is not considered recaptured as ordinary income. Instead, this bucket features a special tax rate, normally 25%. This unrecaptured gain can also be netted against any resulting capital loss. Let's apply Section 1250 to our balance sheet. So we consider our building, the castle itself. With the fair market value of $1,250,000 and tax basis of $1 million, we have $250,000 of gain to recharacterize. We add in the cost basis of $1,300,000 to show us we've already taken $300,000 of depreciation expense. Let's assume all of this was straight-line depreciation, so we are only concerned with the 1250 unrecaptured gain. Since the prior depreciation exceeds our gain, the full $250,000 of gain will potentially be classified as unrecaptured gain subject to a special 25% tax rate. The only way it wouldn't is if we have enough 1231 loss to net it out. Spoiler, we won't. Our final asset, the great acres of land that our castle sits on. Great news, land isn't depreciable, so the full $150,000 of gain will be included as 1231 gain in our 1231 netting calculation. To bring it all together, starting with the ordinary gain or loss. If we net the $5,000 loss from the sale of inventory from the initial facts, with the $10,000 1245 recapture from the forge, and the $1,000 of 1245 recapture from the dining table, we get $6,000 of ordinary income. Now to look at the taxpayer-friendly capital gain rate. Well, I've been alluding to the 1231 netting calculation, and the time has come. Lots of items coming into play here. They are the $20,000 1231 gain from the forge, the $2,000 1231 loss from the throne, the 1231 $150,000 gain from the land, and don't forget, there's still the $250,000 gain subject to the Section 1250 unrecaptured gain, and that's also included in this calculation. And if you net it all together, the gains have it, as we are left with $418,000 gain, with $168,000 of 1231 gains subject to capital gains tax, and the full $250,000 from the building that's subject to the special 25% tax rate. So that's our character study, with 3 different characters of tax rate. One final note here, our 1231 gain is subject to a 5-year look back. If there were any 1231 losses in the past 5 years that we've deducted as ordinary losses, we're required to recharacterize our current 1231 gain, which is $168,000, as ordinary to the extent of those losses. Let's keep this exercise friendly though, and assume we didn't have any. I like castles.